Welcome back to Replicants. This is Michael Mile. It's September 11th, 2024, and I've got something really exciting I want to share with you today. And this time it's not about crypto. Many of you actually started following my work, well, all the way back in 2008 when I studied Evil Speculator, which is a fairly popular trading blog. And, a lot of people have been following me there for, God, going over, what now, 16 years, 17 years. It's been a while. And my main focus was always, of course, stocks, futures, and Forex, and particularly stocks. And then as the years unfolded, also increasingly options. I've become quite an apt and active options trader. In the context of doing that, I learned a lot about implied volatility. And as I dug deeper, I realized that a lot of what happens in the stock market is really driven by the options market. And today will not be about options. So before you turn off, before you switch off and run off, I just want to clarify that. It's something that is good to know if you want to gain a deeper understanding of how the stock market functions, what really runs it, what really drives it. And especially after 2016, with the introduction of weekly options, we saw really a shift. We saw a shift in that a lot of the activity, what happened in the market, was driven by, what happened in the weekly chains. And I don't want to elaborate too much on that, but the expiration of those chains really started driving price, and it became kind of like the tail that was wagging the dog, so to say. And a lot of people had to really shift their approach in terms of how they were trading the market, the stock market, in the context of how options were being traded and also what they saw in regards to volatility. Because volatility means risk. And if you know what your risk range is, right? If you know, okay, my one standard deviation of probability in terms of price movement will be from here to here, then you can structure your trading accordingly. For instance, you could be selling options outside of that. Or you could, maybe buy a spread that trades within that range if you want to trade directional, maximizing your wins, because otherwise you're just wasting money, right? So that's again another story, how to maximize your wins within a defined range, right? This is not what this is about today. This is actually about something really, really cool. And what you see on the screen right now is an old graph actually I produced many years ago, and it's still running on both Evil Speculator and Replicants. I'm showing the Replicants version. It's the same graph, right? And it shows you two lines. Well, actually shows you one line. This one right here is the IVTS signal. And IVTS actually stands for Implied Volatility Term Structure. What is that? Okay, very simply, you probably have heard about the VIX. And it's mentioned actually right down here. So right now the VIX is around 19.45. That traditionally actually was considered bearish, right? Things have changed a bit over the last few years. And but back in the day when I started trading, 19 was starting to be bearish territory. Then there's the VXV. Well, it's a VIX3M now, because actually the VIX that measures 3 months volatility versus the VIX originally, this VIX here, the VIX that you know, the VIX that you probably look at every day if you're a stock trader. That one is based on 30-day volatility, and I have kind of a rolling schedule of futures contracts to look at to calculate that as a formula, and you can look that up online. Again, that's something I'm going to explain today. But it's a signal, and I've been mucking with this signal for a very long time, and I've come up with a, slightly smooth version of it that actually plots where it should be based on what's happening in the market, and that's my secret recipe. And when I ran this for the last few years, I remember talking to a quant trader friend of mine. His name is Tony, really good trader, by the way. And I kept showing this chart to Tony. And I said, dude, look at this. I see an edge here. This is really, really strong. And you're looking to say, yeah, okay, maybe, And we were actually trading this via options. But the other day, I took another look at this. Because actually, a lot of you guys have been contacting me and writing me, and also on YouTube, saying, hey, Mike, I really always appreciated your work, and you talk so much about crypto. What happened to stocks? And I'm like, yeah, okay. I'm still trading it. I'm still trading options all the time. I'm still running Replicants Unlimited, where I post options trades all the time. And I have a bunch of happy subscribers who really enjoy the service. So no, I'm still active, of course. I haven't been talking too much about the equities market, though, and maybe it's time to bring some of that back. And this might just be a good opportunity, because this is really a great edge that I uncovered, and I want to share that with you. So if you stuck with me so far through this lengthy introduction, then it's going to pay off, because let me show you what I came up with. So this is the original version, right? And again, just to kind of put it in a nutshell for you, in case a lot of this stuff I just talked about went over your head. So you're basically taking the 3-month VIX, 3-month volatility, and you deduct from that 1 month, 30-day volatility. Why would you do such a thing? Well, you want to create a delta between what long-term risk is in comparison to short-term risk. And again, why would you do that? Well, because it actually tells you a lot about what the market thinks short-term. If the market thinks that short-term there's a lot more risk than on average, the delta between long-term risk and short-term risk, if that range keeps expanding and compressing, so to say, I think it's probably a better way of explaining it, then it's reasonable to assume that when it compresses beyond what it usually is, there might be trading opportunities. And if it expands beyond what the average or the median is, traditionally, or at least within a certain range, let's say the moving average, that you measure, you could do that, then there might be a trading opportunity as well. Interesting, right? Interesting concept. Well, that's what I thought. So I thought, hey, I can probably build upon this, and that's what I did. So what I've done basically, and I'm going to go step by step with you, right? I've basically produced this graph a little bit bigger. And what I've also done in comparison with before, I've plotted the spiders right behind it, in light gray. See that behind the logo? That's kind of where it ends. Maybe I should move that logo down here. That might probably be smarter, given that we've been moving up a lot. But that's really not that important. What you need to pay attention to are the spikes here, especially the big ones, right? Especially the ones that move beyond the control signal. So if you're looking at IVTS RPQ for big ones, I couldn't find a better name. You'll see that it has a tendency to revert back towards what I think the signal should be, or what my algorithm thinks it should be. Smart algorithm, because normally it's correct. And this is how this looks like. So now let's do something else, right? Let's, for example, set this to true and run this again. And I'm going to show you this again. And this chart is going to change in a second. Oh, of course now. Yeah, okay. I think it did it. Let me pop this up again, the graph. Oh, yeah, there you go. And now you see all these lines, red, well, crimson and light green lines, right? And those are actually trading opportunities. It's hard to see when there's so much data, so it's actually zoom out a little bit, right? Let's go to our, let's say, 180 days, right? I've coded in a way that I can zoom in and out, and because I wanted to really be able to show you this properly. So now you see the graph has just changed. Let's pop it back up. There you go. Did it actually? I think it did. There you go. Yes. And you can see it a little bit better now, right? And see how these lines line up with tops and bottoms. And of late, there's a threshold that I use, right, in terms of the deviation, and it seems to work extremely well. I didn't really spend actually much time optimizing this, to be honest. I just did this all yesterday, everything, the whole thing. And I got pretty excited about it because I said, okay, this looks pretty good, but what would that produce in terms of profits? And so what I did first, let me set this to 1 day. I'll tell you what this is. So assume for a second, right? When one of these lines happen here, either there's a green line or red line, and I think you can probably guess what they mean. If there's a red line, you sell, and if there's a green line, you buy. What do you buy? Spider. You don't buy VIX or anything like that. This is not a VIX. You could actually do similar things on the VIX futures. So just FYI, right? You would have to go inversely though, because normally when you buy spiders, the VIX should drop, right? That's what's usually assumed. It doesn't always happen. That's another conversation. Just suffice to say, especially on the downside, sometimes the VIX actually bounces back before price does. So anyway, because it's all about perceived risk, right? If prices dropped so much already, perceived risk actually drops along with it. That's why it's called implied volatility. All right, so we have got 180 days, we've got this, and how would this look like if we would go, and let me run this actually real quick, and then I would go and take profits 24 hours later, 1 day later, one trading day. So let's say at the end of the day, I see this is lining up, right, in a live signal, and then I would basically sell or buy the spiders. I buy one contract, that's how it's being calculated right now. And then I sell it or buy it back the next day, at the end of the day again. All right, so how does this look like? This looks like this, which is actually quite cool. This is in dollars, right? If you buy one or sell one spider contract. Make sense? So you see in red, that's the one that is based on the sales. So it went a little bit flat here. These are the long trades, which did a little bit better, but they actually converged together, which I find really interesting. And the bluish A dotted signal is the one that is basically cumulative combined, both combined together. Pretty juicy, right? So it's a little bit over $7,000. So let's try something else. Let's set it to 2 days whole time as opposed to 1 day. I actually played with this already. Oui. Honestly, that blew me away yesterday. I was like, whoa, that's cool. So the question, of course, now is, that's 180 days. Not bad for 6 months of trading. I mean, 14 grand trading, buying or selling one spider contract. Not bad, not bad. What else can we do? Well, let's take a look at, let's say, 365 days. Let's see if the edge actually has validity over a long term. All right, let's run this. Okay, fetching new data. I've written it in a way that always fetches new data if it needs more data or less data. And whoa, I mean, that's nice. Now we're over 20 grand. So a little bit flat in the first half of the year, but it really built up over the remainder of the year. So it looks like a solid edge to me. Yeah, there's periods when it's flat, but that's to be expected with any trading system. Let's go a little bit further out. Okay, 730 days, right? 2 years. All right. Not bad, huh? Pretty crazy. All right, I've never done this before. Actually, I've never run this. So this is my premiere. Let's do 1,460 days. So 4 years now. Getting more data, okay. All right. Where am I? I think I might be close to $100,000. So this looks like a very stable edge to me. The short trades seem to actually outweigh the long trades. That's quite clear. See that? Over the long term. Not sure why. But even the long term has a very nice edge. And I don't see any major drawdowns in both the long side or the short side. See that? So what can I say? I'm actually really blown away because I've actually been trading this for a while, but I never really bothered to go and write code that actually measures the performance and actually starts kind of honing into what the best hold time would be. I tried several days more of hold days, by the way. Let's say dial it back to 365 days, just to give you an idea. So this is 365 days, right? 1 day hold time. Now I'm going to change the hold day to 3 days. And for some reason, it starts falling apart a little bit. So it's still profitable. Yeah, run. Okay, it has run. It's still profitable, but it's more profitable with 2 days. And I'm going to go to 4 days. I think it starts falling apart. That's too long. So it's really, I think the sweet spot is 1 to 2 days in terms of holding that. And you could probably optimize, it starts falling apart after 3 days. And I'm sure you could probably optimize long trades versus short trades in terms of the hold term. But, why make it more complicated? I think 2 days is perfect. It looks really good. And over the last year, if you trade both the short and the long side, $20,000 in profit, trading one contract. Do the math, right? If you're trading maybe 4, 5, 6 contracts, 10 contracts, I don't know, depends on your pockets, right? So the best way to probably produce a live signal is to measure the live signal at the end of the day, let's say the last half an hour, by closing that time, and then you take action, basically. And then you just hold it overnight until the end of the next trading day. Well, actually, 2 days in this case. If the configuration is 2 days, you hold it for 2 days. Yeah. And yeah, it's pretty sweet. I'm pretty excited about this, actually. I think this is pretty awesome and might be onto something here. So let me know what you think. And I'll see you next time. Cheers.